Now, in the next 2 days, Finance Minister Enoch Godongwana will table the medium-term budget policy statement in Parliament. The minister will, among other things, talk about the binding fiscal anchors as well as counter-cyclical fiscal policy. SABC News is running a special focus, Know Your Budget, in order to help you and us make sense of some words that will be used in the minister's speech. But before we engage our expert, we asked some university students to explain what counter-cyclical fiscal policy is.
Counter-cyclical fiscal policy is when government spends more or cuts on taxes during times of economic need.
Counter-cyclical fiscal policy is when the government spends money during tough economic times, such as a recession, and it will save money during good economic times. This is to ensure that government finances are spent well and the economy can continue to grow.
Counter-cyclical fiscal policy is a fiscal policy tool that the government uses to counteract the effects of an economic cycle. For example, during the COVID-19 pandemic, there was an economic downturn and the government had to use tax reliefs and extra spending on healthcare and maybe measures such as a stimulus package to boost the activity of the economy.
It is the government's way of balancing the economy. So the government basically does the inverse of what is happening in the economy right now. So when the economy is going through a tough time, we're going through recession, the government will feed money into the economy and they will lower the taxes. This helps us as South Africans to spend more money in the economy, which will boost the economy. When the economy is doing well and we're going through a boost and an economical growth, the government will spend less money into the economy and increase the taxes. This is when inflation goes up. So basically, it is about sustaining and balancing and keeping the economy going when it is too slow and when it's too fast.
Well, those are some university students. But for more on this, we're joined by Patrick Mathidi from Aluwani Capital to help explain the significance of counter-cyclical fiscal policy in the context of the national budget. Patrick, thanks so much for your time. Welcome to Morning Live.
Morning, Senator, and thanks for having me.
So you heard there what some of the students said in explaining the meaning of counter-cyclical fiscal policy. Are they correct?
Yeah, I was just thinking to myself, you don't need me here this morning. You've got all your answers from the students. So by and large, that they are correct. So the government has got two tools, at their disposal. One is fiscal, which is largely around spending, and then the other one is monetary policy, which is more around adjusting interest rates, given what's happening in the economy. So yes, the students are right. A counter-cyclical and a policy stance, more on the fiscal side, is aimed at cushioning, the bumps, that the economy is going through by stimulating growth, in terms of difficulty. But at the same time, when we have overruns in taxes because the economy is doing well, you kind of keep a little bit behind and save for a rainy day.
Just looking back over the years, and maybe if we just go back a few years, how do you think this policy has worked for us? Has it been successful?
Unfortunately not, largely because, you've had, the phrase of the lost decade, which largely speaks to the period when we had very, very little economic growth, which meant that, the government, in trying to stimulate growth, you kind of run out of room in that you end up having to borrow, just to keep the economy going. And without growth, you not have the ability to can pay back that borrowed money very quickly, which means that for the next time there's a crisis, your ability to respond and actually provide some stimulus becomes a lot more constrained, which is what we are seeing currently.
And of course, we know that our South African economy has been struggling on the growth path. But how does this policy work, Patrick, in a high interest rate environment? Because high borrowing costs is also meant to slow demand.
Yeah, so this is where you need, both levers to work well together. That is monetary policy and fiscal policy, because it doesn't help for monetary policy to be constraining the economy because of high inflation, and yet you've got fiscal policy trying to stimulate the economy because of growth. So the two have to work hand in hand, and it's a very delicate balancing act. You can't always get it right, but I must say, though, that on the monetary policy side, I think we've done a lot better than perhaps we have done on the fiscal policy side.
And, looking at where we are currently, should we continue to apply this policy? Should we be tweaking? What's your view on what the South African government needs to focus on in order to, one, get the economy growing? Because I think that has to be key in order for everything else to fall in place.
So I think there's a lot that can be done outside of both fiscal and monetary policy. So you do need these structural reforms to come through. So Operation Vulindlela has to be implemented because that unlocks the growth potential for the economy, which then provides the space for both monetary policy and fiscal policy to actually do what they're supposed to do. Currently, we are using very blunt instruments to try and solve for very deep structural challenges, right? And those blunt instruments largely being interest rates and inflation targeting and then things like that. And yet the economy is not growing for very, very different reasons that need to be addressed. So if you can address the structural issues, hopefully growth will start to lift. And once you have that growth lifting up, it just becomes a lot easier. It creates the room for fiscal policy to play its part in conjunction with monetary policy, because currently, unfortunately, the two are on a collision course where you've got high inflation, high interest rates in an economy that is not growing, right? And hence this, a cost of living crisis that some of us have experienced over the last while.
When you talk about those structural issues, Patrick, let's just look into a few of them that you think are perhaps most pivotal that needs to be addressed.
So I think that there are quite a few. One is, it may sound counterintuitive, but crime is a big issue in that it prevents investments, both domestic investment and foreign investment. So ease of doing business has to be looked at. So thankfully, we have had a few successes when it comes to things like visas and stuff like that, but we need a lot more. And then you look at things, other constraints towards growth. We've just gone, 200 plus days without load shedding. That is great, that is fantastic. But then we need to make sure that we would not repeat the same mistakes on the waterfront, right? Because with water, unfortunately, you do not have much of an option, unlike with energy where you can have solar and all other alternatives. So again, as we try and grow, let's make sure that the impediments that have kept us behind for the last 10 years plus, do not recur and actually trip us, on our way towards economic growth. So Operation Vulindlela, I think, has got a lot of good intention, but it does need to to speed up and make sure that indeed we move away from the 1% growth that we've experienced over the last 10 years and start to move closer to the 3%, which can then alleviate, things like unemployment, inequality in a more sustained basis.
Well, some critics over the years, Patrick, have spoken to the fact that they believe government should move away from austerity measures and spend more. What's your take on that?
Well, again, unfortunately, that's great and fantastic in theory, but we just do not have the space to can spend more, right? Our fiscus is actually, very, very, discouraging. We owe a lot more. Our debt servicing costs are very, very high. And again, if you do not get growth to come in, that just means that we're just living from hand to mouth, right? With no ability to actually grow the economy and stimulate. So yes, in a different world, in a different environment, you do need government to actually stimulate and cut back on austerity. But if your debt to GDP is 75% and growing, right, you're not getting investment coming in, you're not getting the economy to grow, your tax base is getting eroded. You're just heading for a cliff, for which you have no little room to recover from unless you start to change course and make sure that you start to grow sustainably.
And just as we round this up, Patrick, with regard to interest rates cut, do you think that the MPC will be giving us an early Christmas present in that regard, or what is your view on what they're likely to do?
Well, thankfully, if you look at the last inflation number, that has come in a lot lower than expected. So indeed, the inflation path is on the downtrend, which then does provide that scope for the MPC to cut. So our view is that they will cut and they'll give us another 25 basis points just before Christmas, and possibly another one in Q1 of next year. But all in all, we're not looking for massive rate cuts to come through in this cycle. I think we've got another 100 basis points to go, before they pause.
Well, Patrick, thank you so much for navigating us this morning into understanding some of the terminology and the terminography, and of course also your view there on what the MPC is likely to do. Patrick Mathidi from Aluwani Capital explaining the significance of counter-cyclical fiscal policy, among other things, to us.